Hey guys, hope you're doing well out there. We are back with earnings season, kicking off things with all major US banks. Taking a look at JP Morgan, Bank of America, Wells Fargo, and Citigroup. Thought I'd consolidate all of the banks in one video as we can kind of compare them and talk about this industry as a whole. I will have timestamps for each of these companies in the description below. Feel free to jump around to whichever one interests you the most. As always, if you are new to the channel and find this type of content valuable, be sure to hit that like and subscribe button below. It would be much appreciated. Kicking things off with JP Morgan Chase and Company, the stock trading right around $170 a share. I am recording this during the regular trade, so you might see these stocks move around just a little bit. Over the past 1 year, JP Morgan up over 21.5% does give you a small, nearly 2.5% yield. That's $4.20 on a per share basis. Now, taking a look at Q4 revenues, those coming in at $38.5 billion. That was good for nearly 12% growth year over year. Did miss expectations by roughly $1.2 billion. And then non-GAAP EPS coming in at $3.97. That was a beat on that bottom line by roughly 37 cents. Again, $3.97 for a quarter. This company pays you roughly $4.20 for the full year. So you know right there, your dividend is looking pretty safe, can look to be increased incrementally over the subsequent few years. Now, JP Morgan did beat on their bottom line, as we just saw. They see the economy staying resilient, and then they see strong 2024 net interest income. Boy, I tell you what, these banks have enjoyed very high interest rates for basically a year. And if they're still seeing strong net interest income for 2024, yeah, that's probably a good sign for these banks. Also probably a good sign for the consumer, as they're willing to still continue to spend and probably proving that the economy is expected to still stay resilient in 2024. Now, for the next year, they do expect full year net interest income to be roughly $90 billion or $88 billion excluding markets. That compares to estimates on Wall Street at $86.4 billion, and in 2023 compares against $89.3 billion. So roughly flat year over year on that net interest income. But again, keep in mind, JP Morgan is pricing in 6 rate cuts for 2024. They expect the federal funds rate to come in at 4% by the year end. To give you some perspective, right now at Q4 2023, we were sitting at 5.5%. And so with 6 rate cuts, each being roughly a quarter percentage point, that gets you to a 4% federal funds rate by year end. And again, if we take a look at net interest income predicted over at JP Morgan for the next 4 quarters, they expect to see that sequential decline with interest rates coming down. But again, expect to see full year net interest income remain high at nearly $90 billion. So that is expected to remain strong over at JP Morgan. Now, with the sequential decline in net interest income, we see a similar story on their net income, as for Q1 of this year, earnings growth over at JP Morgan is expected to be roughly flat at just over 2%. But then it's really Q2, Q3, and so on over at JP Morgan in 2024 that they are expected to see basically double digits declining on their earnings side. And so as that net interest income comes down, so will JP Morgan's bottom line net income. Similar story painted on the revenue side, as we expect a strong first quarter of this year. And then as the year goes on, revenue is expected to remain basically flat to slightly down year over year. Keep in mind, this is pricing in 6 rate cuts. Maybe if inflation stays a bit more sticky than we anticipate and the Federal Reserve keeps interest rates higher for just a bit longer, you might not see interest rates being cut so rapidly. And so these net income numbers over at JP Morgan might actually turn out better than anticipated. And certainly that I don't think is priced in to the stock just yet. I have the price to tangible book value for JP Morgan over the last 10 years pulled up. This is a metric I like to compare for banks, as it's basically if you were to liquidate all of JP Morgan's assets today, what is the premium basically you would be paying for this stock? You see historically trade somewhere between a 1.5 and 2 times price to tangible book for JP Morgan. Right now we're at 2.11 times a price to tangible book, certainly a bit more elevated in my opinion. I think anytime you get this closer to a 1.5 times, and then really anytime you get it below a 1.5 times, that's probably a strong buy in my opinion for JP Morgan. But really, even just a 1.5 times price to tangible book does make this interesting from a valuation perspective. Certainly is tending to get a bit more overvalued at the current levels just compared to itself on a historical basis. Now, Jumping over to the results for their fourth quarter, we see revenues coming in at $38.5 billion. That was good for 12% growth year over year. Did decline quarter over quarter by nearly 3%. And then you have your non-interest expenses over at JP Morgan coming in at $24.5 billion in the most recent quarter. That was up 13% quarter over quarter and nearly 29% higher compared to same time last year. You see provisions for credit losses also ticking up pretty substantially, coming in at $2.7 billion. A quarter ago, we were at just $1.4 billion, so nearly a 100% jump in those provisions for credit losses. JP Morgan expecting maybe more defaults on those credit cards and home loans over the next few quarters. And so you see them putting aside more and more money. You see last year they were at $2.2 billion on those provisions for credit losses. That was up now 21% on a year-over-year basis. And so your net income down 15% year-over-year, down nearly 30% quarter-over-quarter, even though your top lines did grow at 12% over the past 1 year, largely, due to those provisions for credit losses rapidly increasing. At JP Morgan, and we'll take a look at this at the other banks, but net income did get hurt by a FDIC special assessment. Especially we'll take a look at it at Citibank as they put aside a ton of money due to those large losses in those regional banks at the start of 2023. Yeah, the Federal Deposit Insurance Corp has to recoup those losses, and so companies like JP Morgan, Wells Fargo, Citigroup did recoup those losses, and we'll take a look at that in more detail. Now, taking a look at the different segments over at JP Morgan, we'll start things off with consumer and community banking. You see net revenues did rise nearly 15% year over year, coming in at roughly $18.1 billion. Quarter over quarter, that was a slight decline of just 1%. You see banking and wealth management climbing 14% year over year, home lending substantially rising nearly 100% year over year. This is astounding to see with interest rates being so high still, home lending continuing to prove strong over at JP Morgan. Again, credit services and auto loans did also tick up still 8% year over year. And then your non-interest expenses did also tick up along with that at just over 18%. Your provisions for credit losses on the consumer community banking side went up 19% year over year, 51% quarter over quarter. And so quarter over quarter, that did hurt your net income as it was down roughly 19%. On a more holistic year-over-year picture, was up still 5% on that net income side. Certainly over at JP Morgan in this most recent quarter, you see them putting aside quite a bit for those credit losses. If they do see those consumers remaining resilient, continuing to spend and not really default on their credit or home loans, yeah, these provisions for credit losses will turn into credits down the road and will basically flow right back onto JP Morgan's bottom line. And so I guess if they're expecting the consumer to remain resilient, largely these provisions for credit losses shouldn't really get used up. But again, keep in mind, if inflation sticks around for a bit longer, those interest rates stay higher, you might see continued defaults, especially on those consumer banking loans. Now, their second segment, corporate and investment banking, nearly $11 billion worth of revenues. That was up just 3% year over year, did decline quarter over quarter, down 7%. Non-interest expense rising roughly 4% year over year, declining 9% quarter over quarter. And then provisions for credit losses, they did put aside quite a bit more on a year over year basis at roughly 50% more. And then quarter over quarter, last quarter, you see they had a credit for those provisions for loan losses, and now they put aside roughly $210 million on those provisions. Net income on their corporate side did decline substantially year over year, down 24%, largely due to those non-interest expenses climbing 4%. And then again, provisions for credit losses jumping 50% on a year over year. Lastly, we'll take a look at commercial banking. Net revenues coming in at just over $4 billion. That was good for 18% growth on a year over year basis. And then net income for this segment did climb roughly 16%. So strong net income growth on the commercial banking side. They did still put aside quite a bit more on those provisions for credit losses, up 300% quarter over quarter and then 30% year over year. It seems like the commercial bank side, they are tending to be more cautious and put aside more money for those credit losses compared to a consumer and community banking side where they didn't tick up those provisions for credit losses nearly as much. Overall, the fourth quarter results over at JP Morgan looking fairly steady and strong as we expect 2024 net interest expense to decline. Yeah, as long as the consumer stays resilient, and I think execution over at this bank will continue to be good. JP Morgan is in a very good position for this upcoming 2024. Now, speaking of a very good position, that's what the stock is in, as it's basically made an elevator ride straight to $170 a share. Now pulling back after these earnings just a little bit. I see the first level of support for shares closer to really $160 a share, somewhere between $157 to $160 a share is the first level of support. That wouldn't be a huge retracement from where we currently are, just roughly around a 7% decline, but then a deeper pullback closer to really $150 a share. Sub 150 is where I think you can come in here and pick up shares of JP Morgan, or just really accumulate this stock over a long period of time. I think that's when, again, the price to tangible book will come down just a little bit more. That would be a decline somewhere between 12 to, we'll call it 17%. Again, from a price to tangible book, we saw this one is trading near the top end of 2 times a price to tangible book. Really, anytime this one comes closer to 1.5, 1.6 times, that is where you want to accumulate shares of JP Morgan. Really, we can stretch this back over the long term. This company has been making a very solid uptrend. Any pullbacks closer to $140, $150 a share, I think that is your buying opportunity for JP Morgan. In my opinion, one of the best banks really you could pick up. And so any major pullbacks closer to 140 and sub 150 is really, I think, where you can come in here and accumulate shares of JP Morgan. Now, moving on to Bank of America Corporation, ticker symbol BAC. Over the last 1 year, stock hasn't really done much, down just 5%. Does pay you another yield of close to 2.9%. That is close to $1 on a per share basis. Now, JP Morgan's revenues, Bank of America's revenues for this most recent quarter coming in at nearly $22 billion. That was a decline of 10.5% year over year. Did miss expectations by roughly $1.77 billion. Again, bottom line did beat by close to 6 cents, coming in at 70 cents a share. Keep in mind, the stock pays you 96 cents of a dividend and just posted 70 cents in a quarter. So similar to a JP Morgan, you can expect those incremental bump ups in your dividend over time. Now, from an earnings growth potential, this one does look slightly different from a JP Morgan. As you see, for Q1 of this year, earnings growth is expected to decline nearly 15% and then stay declining really throughout the year. I don't know for Q4 why it says 116% growth, as they just posted 70 cents in Q4 2023. And yeah, if they post 76 cents in Q4 2024, that'll be right around 10% growth, not 110% growth. So probably Seeking Alpha needs to update this, but you can expect incremental close to double-digit declines on your EPS for Bank of America throughout 2024. Similar story on your revenue side, basically flat to slightly declining revenues throughout the next year over at Bank of America. Similar to a JP Morgan, I have the price to tangible book pulled up. If you didn't catch it in that segment, the price to tangible book essentially is the multiple you pay if you were to liquidate all of Bank of America's assets today and then buy those back. This is the multiple you would be paying on that. So for every dollar of Bank of America assets, you'd be paying $1.40 for those. Historically, it does tend to trade slightly above 1 times a price to tangible book multiple. Really, anytime you get closer to 2, likely you can take your profits in a Bank of America. Had been selling off for a while. The price to tangible book did get fairly close to 1 times. Now back up to 1.4 times, roughly in line with where it has been over the past. Now, taking a look at segment results over at Bank of America, we'll start off with consumer banking. Total revenues coming in at $10.3 billion. That was basically down year over year, just a little bit, as a year ago we were at close to $8 billion. And then a quarter ago, we were at $10.47 billion. So incremental declines on those quarter over quarter and year over year revenues. Provisions for credit losses did tick up significantly, at least on a year over year basis, up nearly 40%. Quarter over quarter, again, ticking up just marginally. Along with that, you have your non-interest expense year over year did also tick up to $5.2 billion. Last year, we were at $5.1 billion. And so on your consumer banking side, net income declining pretty rapidly down to $2.7 billion. Last year, we were at $3.5 billion. The other thing declining on their consumer banking side is your average deposits. So looks like consumers continuing to spend over on their Bank of America checking accounts, not really storing money. And then your average loans and leases also ticking up year over year, up to $313 billion. Last year, you were at just $300 billion. So it seems like the consumer still pretty strong, continuing to take out those loans, continuing to decrease those average deposits on their Bank of America accounts. Now, their second segment, Global Wealth and Investment Management, revenue is coming in at $5.2 billion. Again, a decline year over year and quarter over quarter. Provisions for credit losses, not really a meaningful line item for this segment. Non-interest expense did tick up slightly, just a little bit, up to $3.89 billion. Last year, we were at $3.78 billion. Quarter over quarter did decline just a little bit. And so your net income essentially flat to slightly down on a year over year basis. Your average deposits on the global wealth side did also decline year over year, coming in at $292 billion. Last year, we were at $317 billion. And then your loans and leases also just declining a little bit year over year. We see that their non-interest expenses of $3.9 billion was up 3%, driven largely due to higher FDIC expenses and revenue-related incentives. So we saw this with a JP Morgan's, that they had these FDIC expenses due to those bank collapses in early 2023 of those regional banks. And so the FDIC coming after JP Morgan, Bank of America, Wells Fargo to kind of replenish those FDIC funds. Last but not least, taking a look at global banking over at Bank of America, total revenues did decline again for this segment, down to $5.9 billion. Last year, we were at $6.4 billion. Last quarter, we were at $6.2 billion. And then in this quarter, even realizing a benefit for those credit losses of roughly $230 million, still turned lower net income of $2.47 billion. Last year, we were at $2.54 billion of net income for the global banking segment. In terms of average deposits on this side, did tick up year over year up to $527 billion. Last year, we were at $503 billion. And then average loans and leases staying roughly flat on a year over year basis. All things considered, Bank of America's results looking fairly decent. The consumer banking is the only side I would be slightly concerned about, because you have those average deposits ticking down just a little bit year over year. But then again, you have average loans still increasing on your consumer side. So that's still surprisingly strong that your consumers, even in a very high interest rate environment that stayed high for a long time, have continued to take out those loans. Now, taking a look at Bank of America from a technical perspective, this one, similar to a JP Morgan, has made a pretty strong rally really since the end of October, starting November, and has rocketed up to close to $32 a share, hitting its head on a level of resistance at right around $32 a share. Basically, a previous set of highs back in July is where the stock is at currently. I'd say a better level of support for Bank of America would be closer to $30 a share. Certainly, it's a previous set of highs and also kind of where the stock made a monster rally higher. So closer to $30 a share, right around a 10% decline from the current price of $33 a share. And then a lower level of support would be all the way down closer to $25 a share. That is a long time support trend line dating all the way back to 2012, 2011, where we had those double dip recession fears. And really any retracement back to this trend line, I think, can be acquired for a Bank of America. Between JP Morgan and Bank of America, I do like JP Morgan just a little bit more. I think it's a bit more secure and usually deserves a slightly higher multiple than a Bank of America, but I think both these banks are fairly strong in their own space. Now, moving on to Wells Fargo, this stock is up close to 11% over the past 1 year, also gives you a similar dividend, roughly at 2.85%, similar to a Bank of America, JP Morgan, in that 2.5 to 3% on that dividend side. Revenues for Wells Fargo coming in at $20.5 billion. That was up 2.2% year over year, did beat estimates by $100 million. And then non-GAAP EPS coming in at $1.29, that did beat by roughly 20 cents. Now, Wells Fargo in this fourth quarter did assess a nearly $1.9 billion expense from the FDIC and realized nearly a $1 billion assessment due to severance expenses for planned actions. And so you have a few one-time expenses over at Wells Fargo affecting this quarter's bottom line earnings. Now, Wells Fargo Q4 hurt by the FDIC, as we just saw, and severance charges, but they do see improved growth. I think over the long term, due to these severance charges, I think that will get realized over at Wells Fargo over the medium to long term. Now, for the next year, the bank did say net interest income could be lower by roughly 7 to 9%. That's on the basis of lower interest rates and an expected decline in average loans and further attrition in consumer and lending deposits. And so Wells Fargo is certainly seeing lower interest rate, net income, and then declining loans and lending deposits. Certainly we'll have to take a look at that over the next year at Wells Fargo. This stock does trade at a slightly lower price to tangible book multiple than a Bank of America, certainly lower than a JP Morgan. Right now trading closer to a 1.3 times price to tangible book. Over the last 10 years has come down pretty significantly, down from 2 times a price to tangible book. Really, anytime you can get this one closer to a 1 times price to tangible book, that would be, in my opinion, a decent buy for Wells Fargo. Really, anytime below that, close to 0.8, 0.7 times, is really when you want to acquire this stock more aggressively. Now turning over to the operating segments and highlights for Q4 at Wells Fargo, you see across all of their segments, consumer banking, commercial banking, corporate and investment banking, and then wealth management, they saw lower average loans just by a marginal amount, close to 1 to 2% declines on those average loans from both a year over year and quarter over quarter perspective, not really budging to slightly declining. And then on those segments from an average deposit side, they did see more declines, nearly 10% on their consumer banking side, 7% on the commercial banking side, and then a 28% decline on those average deposits on the wealth management side. So overall, you have your average loans declining a decent amount over at Wells Fargo, and then average deposits also declining just a little bit. And so your consumer over at Wells Fargo, both your consumer and corporates over at Wells Fargo, not really proving to be as strong as your consumers at Bank of America and JP Morgan, where you saw average loans ticking up just a little bit, even in a high interest rate environment. And then you saw roughly slightly higher to flat average deposits on those banks. Now, Wells Fargo and really all these banks do have a pretty decent buyback in place. So Wells Fargo repurchased close to 52 million shares or $2.4 billion worth of their common stock just in the fourth quarter alone. Again, these companies have a buyback, pay off a dividend, and are quite shareholder friendly in a general sense altogether. Now again, Wells Fargo did experience those charges, close to $2 billion from FDIC and then nearly $1 billion from severance in the fourth quarter. That did impact their bottom line. Moving over to the technicals for Wells Fargo, this company really has been consolidating for, we can call it about 2 to 3 years, has been locked in this range really between $38, $39 a share, all the way up to, we'll call it $60. Really, anytime this one comes south of $40, I think you can look to pick it up just incrementally, maybe add a few shares here or there. Anytime it comes closer to this $40 a share and then up north of $50, I think that's where you can look to sell Wells Fargo, take your profits. Really has been range bound in this range for a while, coming down to a support closer to $47 a share right now. And then I think below that, your next support sitting closer to $40 a share. Not really interested in jumping into Wells Fargo at these levels. I think both from a price to tangible book and then also from a technical perspective, not really trading at the most attractive levels. I think closer to a $40 and sub $40 a share, this company does become more attractive. Certainly out of a JP Morgan, Wells Fargo, and Bank of America, I do prefer JP Morgan and Bank of America a bit more than a Wells Fargo. I think if you had, let's say, $100 to invest in these banks, I would put majority of that in a JP Morgan, Bank of America, and then a little bit into a Wells Fargo. Certainly doesn't have the same growth rates compared to the other two banks as we've seen before. Last but not least, jumping over to Citigroup. This one has been the underperformer from all these major banks really over the long term. Over the past 1 year is up nicely over 8%. Does pay you a close to 4% yield, so much higher than the other banks we looked at. Those were closer to 2.5% to really 3%. Citigroup does give you that 4% yield. Now, revenues for Citigroup does come in at $17.4 billion. That was a decline of 3.3%. Missed estimates by roughly $1.36 billion. Non-GAAP EPS coming in at 84 cents. That did beat by close to 11 cents. Now, Citigroup does plan to lay off nearly 20,000 jobs over the next 2 years. That is a significant amount of their workforce, roughly about 10% of their workforce over the next 2 years. That's part of their transformation by the CEO to kind of streamline the business, make it more efficient. And then along with that, they also expect to shut off another 40,000 in headcount due to a spinoff from their Mexican consumer bank. And so right now at the end of 2023, sitting at roughly 240,000 direct staff, and the plans are to get that down to 180K by the end of 2026. So significant cost cuts over at Citigroup, hoping to really right-size this company over the next 2 years. Now, similar story really that we've been seeing across all the other banks. Next year expected to have slight declines on their EPS side. For the first quarter, expected to decline EPS close to 11%, and then basically flat to moderate declines over the next full year on both that earnings and revenue side. Again, revenue is expected to stay roughly flat to declining. Now, historically, on a price to tangible book, Citigroup certainly doesn't trade where the other banks have traded. This one tends to be under usually a 1x price to tangible book, which is actually pretty surprising because you're actually paying less than the tangible book value of the assets over at Citigroup. And so for every dollar of asset you have over at Citigroup, you're paying basically 60 cents for that. So certainly trading at a discount, especially when you compare it to its peers in the sector. Now, anytime really Citigroup comes closer to a 1x tangible book, that is usually when you come in here and take your profits in Citi. And then really anytime under 0.6, 0.7 times seems to be a pretty decent buying opportunity for Citi. This was recently at under a 0.5 times price to tangible book, certainly very discounted compared to its peers. Now, revenues again in this most recent quarter coming in at $17.4 billion. That was down 13% quarter over quarter, down just 3% year over year. And then full year revenues did come in higher at roughly 4% year over year. The big thing was expenses over at Citigroup. That jumped 18% quarter over quarter and nearly 23% year over year. And majority of those expenses are, again, those one-time charges due to the FDIC special assessment. That was nearly $2 billion. And then they're experiencing a close to $0.8 billion restructuring charge. Also, they are experiencing nearly a $1 billion charge due to the currency devaluation over in Argentina, and then also transferring risk out of Russia and Argentina. That was close to a $1.3 billion pre-tax charge. So all in all, close to a $4.7 billion charge on that expense side. That was a headwind of nearly $2 per share from an EPS perspective. So certainly a ton of one-time charges. You can expect maybe some more restructuring charges as those headcount numbers continue to decline over the next 2 years. The other line item over at Citigroup really that exploded was your credit costs. Those were up nearly 92% year over year, and then for the full year up 75% on your credit costs. And certainly that is going to affect your net income in a pretty substantial way, as net income over at Citigroup for the full year did come in down roughly 38%. And so no wonder when you see the stock trading at a far steeply discounted price to tangible book compared to its peers, that's because this company really has underperformed from a financial perspective. And I guess part of these layoffs and job cuts is really to right-size this business and really divest out of businesses that aren't very profitable over at Citi. Moving on to the technical analysis, this one has rebounded from its lows of close to $40 a share by the end of October, has seen a decent rally since then, is similar to a Wells Fargo, has been range bound for really many years. We can go back all the way to 2013. It was basically the same price as it is today, and so certainly has been range bound for a long time. Currently trading right around a resistance level close to $50 a share right now, just at $52 a share. I'd say that is where a decent amount of resistance is for Citigroup. I think it has this long-term support trend line closer to $38, $40 a share. Certainly at that point could come in and step into shares of Citi. Not really as well run as a JP Morgan, Bank of America, and so not really any reason I see to pick this one over the other two. Certainly you do pay a premium to those, but in my opinion, I would rather pay a slight premium in order to get a higher quality business. And certainly I think with Citigroup, we have to give it some time in order to really play out these reorganizational changes, see how they affect the bottom line, see how they affect revenues, and really see if this bank can continue to move forward in the right direction. Right now, I don't really see any reason to come in here and pick up shares of Citigroup. Now, last thing I did want to discuss was if you are looking to get into this industry, into the financials, without really picking a winner or loser, you could certainly take a look at the XLF Financial Sector ETF. The top 10 holdings include your Berkshire Hathaway, which we'll get into in a few weeks when they report earnings. But then your other top holdings consist of JP Morgan, Bank of America, Wells Fargo, and then Goldman Sachs, Morgan Stanley, and other banks like that. And so largely your holdings consist of your JP Morgan and Bank of America. And really, I think those are your top two banks. If I was to invest in the financial sector, certainly those are the two names I would first go for, and then split my money up across a Goldman Sachs, Morgan Stanley, Wells Fargo, and so on. And so from that perspective, certainly the XLF ETF, not a bad play if you want to gain exposure to the financials. I think this is something anyone looking to invest in this space certainly should consider. And then you also get other great companies like a Visa and a MasterCard, and not to mention a Berkshire Hathaway. That was a look at fourth quarter bank earnings, which we just saw from JP Morgan, Bank of America, Wells Fargo, and a Citigroup. We really kicked off earnings season today, and then we'll continue with some more bank earnings next week with Goldman Sachs, Morgan Stanley, and then some smaller banks like an Ally. You also have a chip maker in TSMC reporting next week. And then really it's the week after where we kick off tech earnings with likely Netflix and Tesla reporting. Let me know which companies you want to see me cover on this channel. Certainly we'll be back covering all the major tech earnings in just a few short weeks. Thanks so much for listening. Let me know down below which of these bank stocks you are most interested in and your thoughts. As always, thanks so much for listening, and I'll catch you guys in the next video.